The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and we're going to give you some tips today that are going to save you a lot of money if you're interested. And we, of course, want to hear anything that you have to say, tax and money related. So our phone number here in the studio is 803-0930. 803-0930, star 930 on a cell phone, and you can text us. We love your text. 716-803-0930. And I got my buddies with me, Christopher Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. And Tiffany Fabian.
Hey, happy Saturday.
I know, I was watching on YouTube the way Lahaina used to look.
Oh,
I mean, it was, they walked down Front Street, and I remembered all those places, and I just can't get over the devastation.
oh my gosh, we were
If
just
you've
there.
ever been to Hawaii, you just know what we're talking about, to Maui.
Yeah, we were just there 2 years ago this week.
Yeah, really
mean,
was so sad.
it's-
I mean, just goes to show you can never put your faith in anything in this world. You really can't.
Yep.
You just be thankful for everything you got.
Yeah,
as
for
long
that
as you got it,
whole
right?
town to get wiped out. is
a cheeseburger in paradise. Oh my God.
It-
And the art galleries, and all that art.
oh gosh, I know.
Anyway, and they got a big casualty loss too. Speaking of taxes, our tax school's starting pretty soon, right?
Yep, it is. It's end of September, and it meets twice a week, either in the mornings or evenings. It's free of charge. You do have to purchase a book, and there's a 2-for-1 special. There's also an online version if you're so inclined to just take it at home and in your leisure. And so lots of options. You can go to egtax.com, and there's a link to register online. And if you like, we can mail you the registration form. But it's a great opportunity to learn taxes from A to Z. And, as you always say, you'll be the hit at the party. And the best bet, I think, is you get to work for us. If you would choose that option, we would be delighted.
If they have a good
And
grade.
this year, we're having classes in Orchard Park, Springville, Batavia, Depew,
Out and about.
Tonawanda, Niagara Falls, Lockport. So wherever you are, we're going to have a class right
Or
there
even
for you.
in your den.
Even in your den, in your
Right, so
pajamas.
if you did the online version. We find that the online people, though, aren't quite as diligent as the people that actually show up for class. And there's a real benefit about being in class. You get the flavor of the teacher, and you can ask questions, and they tell stories, and it just makes it great.
Yes, for sure.
Right?
Sure.
Okay, so it's almost the middle of August. I cannot believe it. And it's so sad. The other thing, I go to my mailbox today, and I get a catalog with Christmas stuff.
Oh.
That's depressing.
I thought you were gonna say you got a J.C. Penney or a Sears catalog.
No, I got a catalog about. It started off with fall stuff, and then all of a sudden it was ornaments and stuff. And I thought, oh my gosh. But anyway, that really kind of makes everybody think about what's coming up here in the next 4.5 months, and that's the end of the tax year. And one of the big things in tax law this year is the electric vehicle credit. And really, it's been very confusing. So I want to do a little thing on the electric vehicle credit. And basically, it's a $7,500 credit for a new electric vehicle, up to $7,500. And if you get a used electric vehicle that qualifies, it's up to $4,000. And the state of New York has given a credit that can go towards the purchase price of up to $2,000. So think about that. That's like $9,500 that you would save in taxes. Now,
That's a lot.
personally, I'm not much of an EV kind of person, but my job is to make sure that if you are if you don't have big distances to go, and I just talked to my nephew the other day. They had me over for dinner, and he had a Tesla, and I said, Mark, did you really like that? Because I knew we were doing this thing on EV credits this week. He said, and Esther, I loved that car. That was remarkable. But then again, I saw the truck guy that was camping in Alaska or something, and he had to go to get another car because his car ran out of juice. And that's the scare. They say the major thing when you have an electric vehicle is the fear of running out of juice.
Yeah.
Yeah. Well, pretty funny though. I know your nephew. He has a Tesla, but he also has a motorhome.
Well, he turned in the Tesla.
Yeah,
he said
I
he
know.
loved
But I'm
it.
just saying
But he turned it in, and there was a time, because he's a big pickleball person, there was a time when he was at a pickleball tournament and he was walking around with his cord because he couldn't get home. Just saying.
I know when we're out walking the dogs and somebody in the neighborhood has an electric vehicle and they come by, it's so quiet. You can't hear it.
They would hit you. And
it's
you don't even know.
dangerous.
Okay,
It's
so
really quiet.
So the electric vehicle credit is a maximum of $7,500 on the federal, up to $2,000 credit when on the purchase price on New York State. The vehicle has to be less than $80,000 to qualify for the credit. If it's a pickup or an SUV, up to $55,000 for other vehicles, and if it's a used vehicle, it's at $25,000. Now, you have to have modified adjusted gross income if you're single of $150,000 or married separate, $150,000, $225,000 head of the household, and $300,000 married joint. On used cars, it's half of that, 75, 112.5, and 150 if married filing jointly. The vehicle has to be, the final assembly has to be in North America. The battery requirement is that the battery must be assembled or manufactured within North America. The first year, 50% of it, then 60, then 70, then 80, then 90, and 2029 through 2032, 100% of the battery has to be assembled and manufactured in the United States. And that's half of the credit, $3,750. Then there's the critical materials requirement. This is so weird. They have to be extracted or processed within the United States or within the country to whom the United States had a free trade agreement in order to get the other $3,750. Now, the cars that qualify, there's some BMWs that qualify, and that would be the X5, and the MSRP is $80,000, so it qualifies. The Cadillac Lyrica, that has an $80,000 top, so that qualifies. Ford Escape, E-Transit, F-150, that's the guy that ran out of juice in Alaska. Mustang Mach-E, Jeep Grand Cherokee, the Rivian, I think they just went bankrupt. Didn't they just go bankrupt?
I don't know.
That they applied this week because not enough people are buying their vehicle. Tesla Model 3, Model 3 Standard, Model 3 Performance, Model Y, Model 3 Long Range, all-wheel drive. And so those of you who qualify this year. So if you need any help, remember, it's a lot of money. Now, here's the interesting thing. If you are somebody with low income and this is not a refundable credit. So you either have enough taxes to absorb the credit or you lose everything. But they're going to allow you to take your $7,500 credit if you don't have enough liability, and apply it to the dealer, who then will put that towards the purchase price. And that's the same thing with the $2,000 credit for New York State. So your dealer applies that credit towards the purchase price.
Yep.
And that's what
We'll
I got
get
to
into
say.
that more. I don't know if you want to talk to Ray before the break or
Hey,
after.
no, we're gonna. Ray, I know you're waiting. I'm Esther Gillies, the tax lady. 8030930, 8030930. Star 930 on a cell phone. We're gonna take a short break, and we'll be with your calls on the other side.
We are family. I got all my sisters with
Hey, to us, you are family, and I hope you think of us as a firm that has your best interest, because it's tough having somebody with your best interest in mind. We really do. And you don't have to be our client in order for us to answer a tax question or help you with an audit letter. We really believe in the cast your bread upon the water theory. You just help people, and if you do, then they'll come to you when they need help, and that's all we want to do. So anyway, we have Ray, who's been waiting. Hey, Ray, this is Esther Gullius. How can I help you, sir?
Yes, hi. I'm in the process of selling my mom's home for about $220,000.
Okay.
She gifted it to me back in 1998.
Okay.
How do I determine a loss, or it's got to be a profit? How do I determine a gain, and how do I report that?
All right. Did she actually gift it to you, or did she put it in a life estate, or did you inherit it from your dad as well?
No. My dad passed away first, and then my mom had it, and we decided to put it in. We went through the legal steps, and I
Okay,
followed
but
it.
illegal steps
Was
to
your
what?
was your name on it or on the property taxes, or was it still mom's?
No, my name's on the property tax.
Okay. And mom's name's off, right?
Mom's name is still on.
So she's still a 50% owner?
Well, she was. She passed away in October.
Okay. So let's see if I have this right. So originally there was a house that mom and dad both owned. Dad passed away, right?
Right.
After dad passed away, mom gave you 50% interest in the house because she retained half ownership.
Yes. When my dad
Okay,
passed
so-
away, we filed the forms. My mom became 100% owner. I had nothing to do with it. Then after a few years, we decided, all the, the news about possible nursing homes and
Right.
look back periods. So we went through, an estate attorney, and we transferred the ownership to myself. I could file forms, gift tax.
So she
forms,
was not on the title at all upon her death.
Well, she's no. You're right. You're right.
Okay,
It was
so,
transferred.
all right,
we
so
filed
here's
the
the deal.
title papers. You were 100%. I'm sorry. Yes, it was
Okay,
transferred
so here's
to
the
me.
deal. You have to go
upon her
back to what mom and dad paid for the house originally, plus improvements. Okay, because this is what we tell people all the time. Gifting it is the worst thing upon the death of the person that did the gift, because it goes back to their original cost basis plus improvements. You do have a little light because when dad passed away, mom at that point in time would have got a 50% stepped up basis at the fair market value of his death. So originally, whatever mom and dad paid for the house, 50% of it plus improvements would be mom's cost basis. Then the fair market value that it was worth at the time dad passed away, half of that would go towards the adjusted basis. You'd add those two together, plus the expense of sale that you might have paid a realtor or whatever, and that gives you your adjusted basis. From that, you would subtract that from the $220,000, and that would be your gain.
And that's reported on
Schedule D.
tax. Okay, I got you. All right. Thank you very much.
All right, thank you for
Yeah,
calling.
and
Thanks
if
for
you
waiting.
want to work up numbers during the week, give us a call and we can figure it out to show you how much tax to keep us money to keep aside for taxes.
Right, because,
know what?
and this
might
is
take you
really
up on that.
important for people to
Yeah,
know
thank you
that
so much.
You're welcome.
you want to go back and make sure that you know as best as possible what mom and dad put in that house if it was gifted to you. While your parents are still alive, you want to make sure that you say to them, what did you do to that? What did this cost? What did that cost? So you can come up with a good adjusted basis. Really important. But had she given the house through a life estate, then we wouldn't be having this conversation, because his fair market value would have been what it was worth upon her death, which
Right.
would have been probably the $220,000, which meant that he wouldn't pay any taxes at all.
Right, exactly.
So that's what's really important.
And that's what's so fascinating about tax law, all the different things you have to know, realize for a simple thing of selling a house. There's so many different caveats.
And that's probably, and especially what's happened in Western New York. I mean, houses went from 100,000 to 300,000. It's just been bizarre. So you want to make sure that if you're somebody that had that house gifted to you, you might consider gifting it back to the person who's living there, who's usually mom or dad, so that they can then do a life estate and give you the house that way.
Yeah, and I would really recommend that Ray talk to Chris during the week. I know when Chris teaches us to his class, he has like a pictogram
draw a house
and he has a pictogram plus, minus, subtract, and then the stepped up basis. So it gets really confusing. And
Well, it is very confusing.
yeah.
And to do it wrong is, and looking at this house, let's say mom originally and dad paid $70,000 for it. Well, you got $150,000 gain, And so that's, with the state of New York, about $40,000 you pay in taxes. If it's just simple like that, but you got to make sure that you know all the twists and turns.
Yeah.
Okay. All right, and we got. I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on a cell phone. And during the week, if you have questions, you can go to our website at egtax.com. Ask the tax lady, and I will write you back right away. We got a text, right, Deb?
Yep. Can you move that help where it says help? There are special rules for leased electric vehicles. Some call it a loophole. There are no limits on car price, income, or origin of the car, but the credit goes to the dealer. There is nothing that prohibits the dealer from passing it along as a discount. It should always be part of the negotiation when you're negotiating electric vehicles. And I think that's what you began to allude to.
Right. Well, if that's what I've said. If you have a very small liability and you're not going to get the deal, you're not going to get really any benefit for it. Well, the $2,000 from New York State has to go on the car, but it's a fully transferable credit. And so you can give that credit to the dealer. Then the dealer would put it as a down payment on the car. However, you do have to come within that AGI limit.
Yeah, and that's why the person rightfully so taxed it should always be part of the negotiation when leasing an electric vehicle.
Or buying.
Yeah.
Or buying.
Yep.
So, and remember, if it might not be the whole 7,500, it could be half because it didn't match the muster that I talked about. Again, can we put this on our website, Chris? Tiff?
Yeah.
Yeah, we'll make sure we put this on our website if you have any questions, okay? I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we got Jim. Hi, Jim. How can we help you?
Yeah, hi, Esther. I've got a question. I've asked you one probably about 6 months ago. You were a plethora of information, phenomenal information. I'm
Thank you.
62 years old. I'm thinking about retiring. I've been with the same company for 36 years. I'm a real estate investor, and I'm thinking about cashing in all the investment properties I have. However, I know there's no way to mitigate that.
No,
But
that's
is there
not
a
true.
way
That's
of
not true.
getting- There
That's
you
not
go.
true.
That's what I'm calling.
So you can do an exchange, a 1031 exchange. So let's just say you have $1 million worth of real estate, adjusted basis, $1 million, and you say, you know what, I want to get rid of my all my little rentals. You can exchange that for other form of real estate, such as you can buy maybe a large. You can become a partner in a larger real estate apartment complex or commercial property, or if you wanted to go to Florida, you can exchange it for rental property, a big rental unit in Florida, or you could go into something passive like investing in Family Dollar, where they just send you money and you don't have to do anything. So there are ways around paying all those taxes.
Yeah, I didn't realize the Dollar General would be considered a 1031. I know
Right.
with the
Well, you'd own the
1031
building. You'd be a part owner in a limited.
It's called a
liability
tenant in
company.
common.
Right. On the building, not
what?
on the business, on the building that then leases it to Dollar General, for
A
instance.
tenant in common.
Right.
tenant in.
Common, because you go in with somebody else, so you have the
Oh,
same tenant with 3 different owners. It's almost like
Right.
a
Or 5
partnership
different
without
owners
a
or 10
partnership.
different owners. Yeah.
Yeah.
I see. And I know there's limitations, a time limitation with the 1031
Right.
exchange.
So you
Would
have
that
to,
be
right.
applicable?
You,
Yes, that still comes into play, the time limit.
right.
Okay.
But it's so much easier if you're deciding to go into something more passive like that. It's already set up, and they're looking for for investors. So
Yeah, as a matter of
I-
As a matter of fact, before it even changes hands, before the deal's even done, you have to have the real estate exchange person on board with you.
Identify
The money can never touch your hands.
right.
Correct. That's that gentleman Russ.
Yes.
Right. So here's the thing: if you're, if you let's say your basis you've depreciated it down to 0 and you're selling it for $1 million, you're going to pay about, with the state of New York, about $400,000 in taxes. But if you do the 1031 exchange, you don't pay
Yeah.
anything. Then your hope is that you die, and then your kids inherit it, and they get a stepped-up basis.
Yeah, if anything, I would not do them all in 1 year. You'd want to spread it out.
Not
Yeah,
necessarily.
I'd really get slapped by the capital gain.
If you're not going to do a 1031. Anyway, we got to
Right.
take a short break for the news. I'm Esther Golias, the tax lady. We'll be back on the other side. Hey family, I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. This electric vehicle credit really is confusing. And so there are lots of things. But the great thing is the dealer knows if their car qualifies. And they also have to give you a form that says that all of the particulars about whether it was assembled in the United States, that it have the right kind of minerals, is it the right the battery size is the correct size, and so they will give you that. But remember, don't think that you're going to get the electric vehicle credit if your income is lower and you have no liability. It won't go anywhere. So just like that one texter texted in and said, you want to make sure that you negotiate with the dealer. So that means you got to call us first so we can tell you what you'd save so that you can go negotiate. And I don't know about you, but sometimes I just hate negotiating with car people. I guess I'd rather cut off my arm, But anyway, okay, so other things I want to talk about is I'm going to ask you guys, see how smart you are. Do this, not that. So I'm going to give you a situation. Let's say that you're somebody that has credit card debt of $30,000 and you're paying 25% interest, or about $7,500 a year, or $625 a month in interest alone. Okay, and you have a $30,000 401k plan at work. So what do? Do you just keep the debt and forget it? Just kind of keep dog paddling? Take the money out of your 401k and pay the debt off? Borrow against your 401k and pay yourself back over 5 years?
Ding,
or
ding,
go
ding.
bankrupt?
Ding, ding, ding. I like the third one from what I've heard so far. I might need more to consider option 4. But the borrowing against the 401k sounds...
And why would that be, Tiff?
Because you're paying off your debt and you're paying yourself back the interest, and that way there's no penalty for distribution from your 401k because it's a loan, and so you don't have to worry about the penalty or the distribution from your 401k because it's just a loan, and you're getting rid of that 25% interest, and now you're paying yourself back the interest, and so that's a
What
really
do you think,
smart
Chris?
maneuver.
Well, depending, like Tiff said, more information may be needed because, you know what, a bankruptcy may be the thing to do because then you get rid of all the debt If your credit's bad, it will only improve your credit by just dragging your feet along, paying it. You don't improve your credit at all.
So it's absolutely true. So if you did if you went to the employer and took out the 30,000 as a loan, Tiffany's right. You pay yourself with interest over a 5-year period. So at the end of 5 years, the debt's paid off. The debt's paid off automatically once you paid that off with a 30. So you at the end of 5 years, you're back where you started. You've been paying yourself with interest, so your 401k plan is back to where it was. And because what happens if you take the 30,000 out? You just take it out, not borrowed it. You just take it out. What happens then if you're under the age of 59 and a half?
You're paying taxes to the federal and the state, and then the early withdrawal penalty, which is 10%. So it's a lot of taxes that you're paying.
So
Right,
it would cost you probably almost 30%
more.
So that's
If not more with the state.
depending on your income, right?
So you figure you take out 30, now you owe 10.
And
so
how
now
are you
you're
going to pay
take
the
out
10?
10 to pay the taxes next year. So taking money out of your 401k without borrowing it, because borrowed money is tax free. Now we're not people that think, oh well, bankruptcy is so great, but sometimes bankruptcy is a very good tool, right?
Yep, it's like a fresh start. And
Right.
so if you're just lumping along and carrying this ball and chain of the debt, carrying it, your credit is bad. And so sometimes
And you can't fix it.
right. And so sometimes if you not just the option of filing bankruptcy, you get rid of the debt, and then after less than a year your credit is generally restored, and it's almost like a fresh start
It's
in
true.
many ways.
I mean, because if you aren't able to get rid of that debt, and so your credit is bad. Your credit is bad this year. It's credit bad next year. Credit's bad next year. Credit's bad next year. You're still paying all this interest. You're living from hand to mouth. You can't put money into your pension plan. That's why bankruptcy's in the code, the federal government's financial code, because sometimes the best thing for you to do to get rid of that debt is to do a bankruptcy. Now, if morally that bothers you, you can always reassign on the debt later. I mean, once you get yourself straightened out, you can always contact the creditors and say, remember, I had a $10,000 credit card and you forgave it? Here's the money. You
Yeah.
can always do that, but I will tell you, sometimes you really need a shot in the arm sometimes to get rid of that debt.
Yeah, and I want to say I met with a client the other day, and he had a letter that he said he's never seen in the mail before, where he owed $28,000 to the IRS. And I sat down and I was talking to him, and he said, I don't know. He took money out early from his 401k. And I says, well, that's why you owe. He goes, yeah, but it was a loan that I took out because of COVID, because his wife or him
that's
lost his
different.
job. So I'm amending his return because the person who did his return didn't do where they spread out it over 3 years, and he wasn't subject to the penalty. And so if anybody out there is listening and they took a loan against their pension during the years of COVID, there might be something that was dropped off or neglected to be
Well,
done.
actually, it didn't even have to be a loan, right? If you just took the withdrawal, it didn't have to be a loan.
Right.
I mean, you could have just, due to COVID, you could have just taken out the distribution, spread it out over 3 years. It didn't have to even be a loan.
Right. Yeah,
I
that
mean,
wasn't
if it was
a loan. You just spread
then
it
they
out,
really,
and there was
really
no
messed
penalty.
up. Right?
Yeah, right. But so we're fixing it right now.
And that's great. I mean, if you have a big liability, it's a good thing to have somebody else look at it, because
letter.
especially if you did it yourself.
Yeah.
All right. So that's the first one. All right. Second one, you have 3 minor children. Right now, you're getting a refund of approximately $8,000 a year, and you're running up your credit card bills in order to make ends meet, and you pay it off at the end of the year during tax time. Is there another way? Number 1, keep the same withholding and look forward to tax time. Number 2, change your withholding at work so that your refund will be around $1,000 or less, and start putting money into your pension. Or number 3, get a part-time job to offset expenses. What do you guys think?
Well,
Change your withholding.
change your withholding if you can. If your refund's EIC or the additional child
So
tax
should
credit,
they withhold more?
no, they should withhold less.
Change your withholding so that less is going into the federal government, right?
Correct.
Because are they giving you any money on this money that they're holding?
No.
Are you poor because you don't have all your money? You're sending off $700 a month to the federal government, right? That should have been your money. And then in order for you to make ends meet, you have to put it on a charge card. And
Yeah.
they're charging you 25% interest or 22% interest, right?
That's right.
Right. Yep. You know, I mean, yeah, definitely. If it is all withholding, change your withholding. Get
Right.
the money in your paycheck.
You mean it isn't good to get an $8,000 refund? Chris?
Pennies from heaven.
It's not pennies from heaven, though, is
I-
it? It's your
no.
money.
No, correct. It's your money.
Right. And
but-
even if you do have the earned income credit, and even if you do have the child tax credit, that's meant to be there to help you to live and pay your expenses. When you get these gigantic refunds, you do feel like it's pennies from heaven, but it's not. It's really there to assist you in your finances,
That's right.
right?
Yep, and you have to weigh it out. And so the truth is, if they change their withholding, they're still going to have a decent sized refund. And after all, we're already at August.
And they're able to pay their bills.
Yeah.
And maybe they can put money into their pension plan, and maybe they can buy a house,
Yep.
although that's getting hard.
The interest rates are
Okay,
so
we
high.
got a text, Tiff.
We do. It says, Esther, if I get a home equity loan to pay off my credit card debt, can I deduct this on my tax return?
Okay, and that really should have been an option that I had in that question. If you take a look at credit cards, I mean, they're 20-some%. It's like highway robbery. If you could get a 7% home equity credit line, you're dropping it by 15%. That's a wise thing to do, but it's not deductible.
Right, because
It
you're not
used
putting
to be
the money.
deductible. It has to be used to do something to improve your home, your personal home. So paying off a credit card doesn't count.
Now, the truth is,
On the state of New York, you can use it, though.
yeah, and the truth is, there's lots of married couples and single people who aren't even itemizing nowadays if they have a house because the standard deduction is so large, especially for a married couple. But
However,
maybe on
now
the state.
with interest rates going back up, Tiff,
Yep.
that and the cost of the house going up, you're going to find more people itemizing now because of the change in the inflation.
Correct.
Right?
Yep. And then in a couple of years, unless they extend it, we're going to go back to the old standard deductions instead of the doubled one and putting
Right, because
personal exemptions
that's coming
back.
to a close, right?
Right. That's coming
All
to
right.
a close.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to take a short break. We'll be back with your calls and some little quiz questions for you.
We are family. I got all my sisters.
Hey, I'm Esther Golias, the tax lady from EG Tax, and we want to help you. And taxes are confusing. And if you do it wrong, but it's mathematically correct, if your theory's wrong, but it's mathematically correct, they'll never audit you on it. That's the way it goes. They'll let you overpay. So it's up to you to make sure that you have taken advantage of everything and that you plan. You've got a plan. But we have a text here, which is kind of going to show this. So will you read that text, Steph?
Dad is downside.
Sounds like you're in
Is your
Acapulco.
mic on?
Oh, is my mic on? Frank stepped out. And he didn't put, okay. Dad is downsizing to an apartment. He built the house in 1971. The basis is about $30,000. It should sell for $135,000. Based on actuary tables, that is, my portion of the gain is about 75%. Should he rent instead of selling?
So it sounds like he's on the title.
Well, it's a life estate, so because it's a life estate, when the parent sells it before passing, the kids pay the taxes.
Oh, okay, so this is
in
a
the
life
text.
estate.
In the
Yes.
text, it says life estate dash. I'm sorry about that. Life estate dash.
All right. Because it's a life estate, he's going to end up paying taxes on on the portion that Dad doesn't own. Now, Dad's portion will be completely tax-free because he's lived there his whole life. But unfortunately, if Dad downsizes and you're now at 75%, you'll end up paying taxes on
about
75% of the gain.
Yep. So
So should he rent it?
that's a good question
Because if he rents it and Dad went in 10 years, whatever, passes on, then he'd get the stepped-up basis.
right.
But then well, then we got the depreciation.
Right, but it doesn't matter because it's rental property. It's still inherited, so
That's true.
still.
That's
but
true. He'd get the stepped-up basis.
and the thing is, with the rent, the nursing home won't attach the house. They'll only collect the net rent if Dad does go into a nursing home.
Which it can't be that much money.
Right. So
So what I'd suggest you do is give us a call, and then we'll work out all the numbers so at least you have tangible figures to deal with. Remember, even though you sell it for $135, you got expenses of sale, which will also reduce the gain.
right. And then also, just like the caller, if Mom passed away prior to the life estate, there could be more of a stepped-up basis.
That's true. Absolutely true. Okay, I'm going to go back to another, this kind of piggybacks on what we're talking about here. Let's say you're getting older and the largest asset you have is your home. You'd like to make sure the kids get it, so you sign over the title to them at Christmas. Is that a good decision? And the number one is, I hope they don't decide to sell it and kick me out. Number two, I don't gift it without looking into a life estate. Number three, sell it now and give them the cash. Or number four, forget it, let them worry about it when the time comes.
The life estate.
The life estate is the best thing. Or, the selling it, if they were to sell Mom's house while she's alive, then there's going to be no gain. If the gain is less than $250,000, if she's single, $500,000 filing a joint return. So there's going to be no gain.
Well,
and the truth is, I don't mean to be crass, but if she were very ill and maybe terminal, and you sell it, there wouldn't be any nursing home expense anyway, right?
yes.
Yeah, except for the 5-year look back if she's
No, not if she's not going in a nursing home. If she goes to be with Jesus, she's not going to
Right.
need a nursing home,
correct.
right?
Correct.
So it becomes very, very, you really have to be careful. But obviously, a life estate, if everybody's in good health, works the best.
Correct.
It does.
Okay. All right. And then how's this one? You and your spouse are pretty conservative with your investments. You don't like or understand the computer, so pretty much you do things the same way you've been doing it for years. You have $100,000 in a 0.05% savings account because you like the bank. You a paid-for home and $25,000 in your non-interest-bearing checking account. What should you do? Look at moving the money to a high-yield CD or money market. You would make an additional $6,250 in interest if you did. Number two, put the money in your mattress. Number three, go on a world cruise. Number four, do nothing.
I was paying attention to the phone. Sorry.
I would put the money in a CD and then take that $6,000 and go on a world cruise.
There you go. And that's exactly right. There's a lot of people that, we don't like change, and we're used to the way it was. Well, the way it was, there was very low interest rates, but now the interest rates are approaching 6%. And so you can do a 6% CD, almost 6% CD. You can do like a 5% money market, but the thing is, what you don't do is costing you money. All right, let's go to the phones. We're going to talk to Tom. Hi, Tom. How can we help you?
Yes, I'm going through my things and getting rid of a lot of paperwork and that. How far back should I keep my income tax returns?
Well, 3 years is the statute of limitations. They have extended that if they think that there's been
Fraud.
gross negligence. So 7 years would be if if you really want to make sure that you have all your records, 7 years, but 3 years is a statute of limitations. So I guess the answer is 7
And then if you have stocks that have a basis
until you sell it.
until you
right.
sell it, or if you have a business and there's business until you sell it. And then also, if you go to our website, there's a whole document that we have on how long to save your documents. And so I found the easiest way to navigate the website when I'm looking for that is I Google EG tax, how long to save your tax documents, and then it comes up and there's every little caveat and nuance. For instance, if you have a basis in stock, and so if you Google EG tax, how long to hold on to your documents, that's a really good question that you ask, because some people have.
Okay, so you say you're saying 7 years I should go back.
Well, or if you have an asset that you're going to sell and you need to prove the basis. So let's say that you have your house that you paid $100,000 for 10 years ago. You don't want to shred those documents because that proves your basis. Because you could sell it now, right? So,
Yeah.
But generally speaking, with your regular 1040s and your interest and dividends and itemized deductions, 3 years they won't audit you unless they think that something was grossly negligent. Then they can go back 7.
Okay.
Unless
Okay.
your last name's Biden.
Thank you very much.
All right, thank you, Tom.
I was thinking that.
What's that?
I said unless his last name is Biden.
Then you can get away with murder. Okay, so last thing I have here. You've paid for a home which has appreciated to $400,000. You paid $75,000 for it, so it's been a great investment. You're thinking of moving to a warmer climate. What should you do? Give it to the kids? Forget the whole thing? It's too hard. It's too hard to accomplish. Or number 3, sell the house tax-free and fulfill your dreams.
Well, I know my daughter would say, give it to her.
Which daughter?
The youngest.
Would say to give it to her?
Well, she would, because they can't find a house right now.
They can't, nothing that they can afford. That's true.
Yeah. But really, sell the house, take the money tax-free, and enjoy your life.
Right. And at some point in time, really look at really your plan, because let's say that you're in excellent health and everything, and a nursing home is not something that you're going to be looking at. That's great, sell the house. But if you're somebody that's thinking maybe a nursing home might be on the schedule here, and you want to go on Medicaid, you got to be careful about getting the money, because you got a 5-year look back, right?
Right.
Yep. Correct.
And so, it's so fluid. It's every situation is different.
That's right. And
And it was
if not
interesting
this,
because
but
a
that.
friend of mine just lost her husband, and he was fine on Monday, and on Tuesday he was gone. I mean, we don't know how long it is. How long the jig is up. And if you're somebody that has lost your spouse, you want to make sure that you plan, so that you have all of your wills and documents in place, because if you don't have a will, it goes to probate.
Right.
So-
And if you talk to your children, our letter of intent, if brought up our website, we have the letter of intent on our website, which is a remarkable tool for people, because you can list everything you have, so your children aren't running around like crazy trying to figure it out.
Know.
Yep.
I mean, redo the letter of intent every year, and then I go, oh, good, I can die now. But I mean, it makes me feel good, because I don't want my family to say, gee, let's look at mom's tax return. Where did she have savings accounts? And because I have a tendency to move the money around, because I do move the money around. And so I might have been at Bank of America 2 years ago, but not this year. I might have put it in the credit union. So whoever was paying the higher yield, that letter of intent is so great, because it lists all of your assets that year.
Yeah, and I was talking to a client, and now that statements are electronic, there's this one of my clients that found some money that he had at a bank account because he wasn't getting statements. And so you just, with everything electronic, you just don't know where things are sometimes.
And it's going to go more electronic.
Yeah, yeah.
I mean, if it's remarkable what's on the plate in the future. So you want to make sure that if you're somebody that is not computer literate, I will tell you, I think getting started with a laptop, not a laptop, with an iPad is one of the best things.
Yeah,
Don't you think?
it's pretty
It's so
user-friendly.
easy to use.
Yeah, yeah, it really is. That's a good idea. A very
And
good point.
you kind of get used to it, and that little iPad will do really what your big computer does.
Yeah.
Right. You know, and, you know, we talk about planning. I know we had somebody earlier helping an older person, and he had all these bonds with no beneficiaries listed, no time of death, you know, and we're talking maybe $100,000 worth of interest. If that gets cashed in through the estate, you're looking $37,000 in taxes.
On the federal.
On the federal, where if he had the time of death, they wouldn't have to cash them in right away. They could spread them out, and depending on their income, it may only be $15,000. So I mean that's
another thing. And I know it's a pain in the neck to do details, but a beneficiary is a detail that you definitely want to make sure you do, because if you don't have a beneficiary, then and you don't have a will, then the two of them go to court together to the probate.
Right.
So you don't want to do that. So simple to change a beneficiary.
Yes.
While you're alive. Right?
Yep.
I'm Esther Golias, the tax lady from EG Tax. If during the week you got a question, you're thinking about an electric vehicle, you're wondering about everything, if you got a bill from the IRS or State of New York, give EG Tax a call. We don't charge for information. We'd love to help you. You can email me through Ask the Tax Lady. But until next week, I'm Esther Golias, the tax lady, with Tiffany Fabian, Christopher Fabian, and Frank, our guy who runs the controls, and Go Bills.
He
Thanks for
should
listening.
go Bills.